Good evening to all. Thank you for coming this evening. I certainly can imagine why you have come. You haven't certainly come to hear me speak. Our distinguished speaker will be introduced by me momentarily, but let me just say a few words of welcome. How grateful we are, Governor, that you've been willing to come here and speak at CEU. I've noted in your recent speeches, Governor Nowotny has been closely followed by the Wall Street Journal, and every time he gives a talk, they seem to be reporting on it. So that's exciting. I don't know whether that will be the case tonight, but we would certainly welcome it if they wish. I don't know whether he wishes. I was particularly interested in one headline that I saw recently on January 21st, which read as follows: "Don't get overexcited about the ECB meeting," Nowotny says. This is the Wall Street Journal, so he was giving advice to all of us. This, of course, was the meeting at which the ECB announced its new policy of quantitative easing to help fight the risk of deflation. I won't ask him what his views on that matter were, but maybe he'll express them at some point during the course of his talk here tonight. I should say, I can't speak on behalf of the whole audience, but we promise, Governor, not to get too excited about any announcements you may make here today. I don't think anyone here is going to rush out to their bank to withdraw all of their savings based on what you might say. And we are extremely grateful that you have come here to CEU, because we know how busy you are and how important your schedule is to people all across Europe and indeed across the world who are watching with great interest what is happening these days at the European Central Bank. Governor Nowotny is widely recognized as one of Europe's leading central bank governors, and he is also a member, as I've been saying, of the Governing Council of the European Central Bank, and an authority, I might add, on the theory and practice of monetary policy, which will be the topic of his lecture this evening. He is also a longtime champion, I want to particularly note this, of the independence of central banks and their governors, and he has spoken out frequently and eloquently about the importance of independence of central banking and keeping politics out of decision-making as much as possible on issues of monetary policy. He's a distinguished economist and professor at the Vienna University of Economics and Business Administration. He received his doctorate from the University of Vienna in 1966, when I believe you were only 22. And let that be an inspiration to our doctoral students who are here tonight. He finished his doctorate at the age of 22. He's a leading member of the Austrian Social Democratic Party and was a member of the parliament from 1978 to 1999, after which he was appointed vice president of the European Investment Bank. Governor Nowotny is the recipient of many awards over the years, including, I should add, the 2014 inaugural Lamfalussy Award given by the Hungarian National Bank. And we all enjoyed having him here in Budapest just about a year ago to receive that award. I should add, just as a personal note, and I've already said this to Governor Nowotny, I have to unfortunately exit for a short time at the beginning of his lecture because we have another major program that I have to introduce that is on a totally different subject in our auditorium. So please forgive me for that, and join me in welcoming Governor Nowotny to CEU.
Thank you very much, Mr. President. Ladies and gentlemen, I'm very glad to be here. I'm especially glad to be, as I just noticed, to be in the Karl Popper auditorium. Karl Popper is one of my intellectual heroes, and I had the good luck of meeting him in person when he came back in old age to Vienna, which unfortunately he had to leave when he was young, but later in his old age he returned, had a chance to meet him, and was deeply impressed. So I see this, I'm very glad that you honor these personalities, and of course I know that George Soros also has him as his kind of intellectual hero. It is an honor for me to be here at this eminent institution. I also want to bring you the best greetings of my friend Boštjan Jacek, who is the governor of the Central Bank of Slovenia, and who is a graduate of this institution. So you have a widespread network of graduates and of friends. And I will talk a bit about this monetary policy perspectives, theory and practice, and if it is okay with you, then of course I'm prepared to take questions, because I think an academic meeting should be with questions. We had just come from a conference, an interesting one, but where we had, I think, several hours, but no questions asked. And so I think we should return to the academic life here, and I enjoy this very much. Of course, it's theory and practice, of course, and what I will discuss with you just in a moment will be, let's say, the more mechanistic parts of monetary policy. We have to be aware, of course, that monetary policy is not only, let's say, a science, it's also art. A lot of it is psychology, because monetary policy, and in some way banking, is based on psychological concepts as trust. You have to trust that this piece of paper you get as a piece of money is something you can use. It's a lot about expectations, and so therefore it's a lot about communication. And I have to say, the president of the European Central Bank, Mario Draghi, is a master in communication, and you know that with just some few words in last summer, he stopped an imminent crisis. So it is something I think that we all are very much aware of how important it is. This is the mechanistic part of it, and for the students in economics, this is something I used quite often in my lecture. It's about the transmission channels of monetary policy. This is the way how it is going to work, and we have, of course, what we discuss are different, what we call channels. That means, so this is the wealth channel, and we have, of course, a balance sheet channel, bank lending channel, risk-based channel, interest rate, exchange rate. So these are the different ways how, and you see more interest rate policy may work. This looks complicated enough, but it is much too simple. First, of course, what you see here is, and this is the end of it, it's consumer prices. So in this case, this is a model for a central bank that has only one goal, and that means price stability. Price stability in the way of a certain degree of inflation rate. In the case of the European Central Bank, we define price stability as an increase of consumer prices not above but close to 2%. So that means no inflation but also no deflation. We know, of course, that there are other central banks, like the Fed, like the Bank of England, that have more goals. So, for instance, the Fed, famously, with having as their mandate, on the one hand, price stability, plus full employment and economic growth. which means that, of course, and we will see this, that from the mandate, the Fed tends to have a more active, a more expansionary policy as compared to the ECB. There is a long discussion whether this is preferable. It is, of course, to a certain extent, something that has to be seen in the context of history. And I think it's very important, even if the history of the ECB is a short one, it's important to be aware of this history. Because a very important part of this has been that Germany is joining the European Monetary Union. And this was an extremely difficult step for Germany. There is this famous saying that after the war, Germany developed only one way of patriotism, and this is D-Mark patriotism, which, by the way, I think is much more preferable to other kinds of patriotism they had before. So it was not an easy thing for them to give up the D-Mark, and therefore the ECB and the mandate of the ECB has been modeled very much along the model of the German Bundesbank. And many of the, especially also American commentators, who have a very, let's say, critical view of the ECB as being too restrictive and too cautious and whatever, tend to forget this history of the ECB. And I have to say, as a member of the Governing Council of the ECB, I think one always has to be aware that the ECB is acting in this kind of mandate. As an academic economist, I could imagine quite a lot of other alternatives. But as a central banker, I have to work in this legal mandate, and I have to be aware of the history. And I also have to be aware, of course, that Germany is the biggest economy in the European Monetary Union. So I think one should not forget these basic facts when discussing monetary policy. So this is one aspect that makes the whole thing perhaps more complicated. Of course, there is another aspect that might be also relevant. Here you see that we define price stability as stability of consumer prices. There is also another discussion in that sense that, of course, nowadays, and we have had this discussion, by the way, at the conference of the Hungarian Central Bank this morning. The question is, only consumer prices, or should we also include asset prices? And of course, many of those measures that we are taking with QE have a direct effect not on the consumer prices, but on the asset prices. So again, you can have a number of discussions about it, and I will turn to this a bit later. So you see, monetary policy is not something that is straightforward. You have to have different, let's say, channels of effectiveness, and you have, of course, different conditions that you have to think about. So let's have a short look on the situation as we have it now. What you see is that for 2014 and especially also for 2015, we have growth rates quite, let's say, substantially. But as you see it, if you take the big economic areas, of course, the euro area is much below the US, and by the way, also below the UK. So the euro area is, of course, in some way the weak spot of the global economy. By the way, as you see here, Central and Eastern Europe is, of course, still not in those. So these are the latest forecasts that are available. It's still perhaps not in this growth rates that we have had in the high time, but still recovering and having quite the strongest growth as compared to the euro area. So this is the growth perspective. If you look at the inflation perspective, there of course you see that in the euro area for 2015 we expect very low inflation rates. Still changing. It may be something like 0.8 or something like this. And this is headline inflation. This means this is the inflation as it is counted as the consumer price index. Of course, one has to distinguish that in this headline inflation is included the very strong decreases in the prices of oil and of commodities. If we exclude this, we have what we call core inflation. And core inflation has shown a much more stable perspective as we see with headline inflation. So this is, of course, a very relevant discussion that we have. It's quite clear, if you look at these numbers, that ECB is missing its goal of price stability. We should be close to 2%. We are clearly way below. And the question is how to interpret this. Is this something that forces us to act? Is this something where you say, well, these are just specific situations, oil price and so on? If this oil price effect will slow down, then we will come back at least to the numbers of the core inflation, and then we are much more in, let's say, safe territory. The question is, of course, what is safe territory? The fathers of this definition, and this was a definition, I think, done in the year 2003 of price stability as not above but close to 2%, choose this 2% line because they wanted to have a safety territory against deflationary perspectives. So you have to have a certain safety net not to get into deflation. Because it is true, central banks, if they have political independence, if they are strong-willed, they always can kill inflation. We have seen this, the famous situation in the US after the Vietnam War. There was high inflation rates. By the way, inflation usually is produced by wars. It's an after effect of wars. In the US, about 12% at the highest. And then Paul Volcker increased the policy rate to 16%. Of course, this caused a massive recession, but after 1 year, there was no inflation left. So we have strong weapons against inflation. It's much more difficult with deflation, because of course we have the lower zero bound, so we cannot have a policy rate below zero. We can have specific rates below zero, but not a policy rate. So therefore, and as we have seen in Japan and other countries, it's much more difficult to fight deflation. So therefore, there is this idea that we have to have a certain territory to be on the safe side for this. But still, of course, there's a question: when do we have it? To what extent? And I will come to this a bit later. So if you look at the monetary policy developments, of course, the big defining movement for all of us had been this big economic and financial crisis starting in 2007, 2008. In this crisis, central banks reacted quite strongly. And I think one really can say that by acting in this way, we avoided a worldwide economic crisis like in the 1930s. You know, there is this famous German philosopher Schopenhauer who said the only thing that history is teaching us is that nobody is learning from it, which in this case proved to be wrong. And I think it was a fortunate situation that at the board of the ECB and later as president of the Federal Reserve and later as the president, there was Ben Bernanke, a professor of Princeton, whose special field had been the crisis of the 1930s. And if you read his scholarly articles, it's like a blueprint of what the Fed did later. So I think this was really an example where policymakers learned from the crisis. So that means we had to act massively. And of course, what one can act is that we have, of course, reduced interest rates to de facto to zero. And that, of course, there had been a number of operations to increase the volume of money in the economy, to inject liquidity into the system. And the latest one that we decided, and this was what the president alluded to, was this expanded asset purchase program. So that means quantitative easing. Quantitative easing meaning that a central bank is directly buying assets. Up to now, the typical way of how the ECB had been providing or injecting liquidity is by giving loans to the bank and taking collateral for these loans. That means, if you remember what we showed before, using the bank lending channel. And this is especially important in Europe, or at least in continental Europe, because most of the financing in continental Europe is going via the banking sector. In the US, it's different, because in the US, most of the financing is done via capital markets. So the US started with quantitative easing in the sense of buying directly assets on the capital markets and therefore influencing directly the price of the assets on this, in this way. I don't want to go into the technical details here, but as you see, we have had a number of let's say, QE programs, but all of them have been rather small, and only now, with this expanded program, we really get into the, let's say, into the QE business. And you see this if you look at the development of the balance sheets of central banks. This was the time of crisis, where all banks reacted in an expansionary way. And then we see that we have a very different strategy with regard to the Federal Reserve and with regard to the Euro system. The Fed, via QE, buying assets, large amounts, and therefore increasing the balance sheet. The ECB giving loans to the banks, and as these loans start to be repaid, the balance sheet of the ECB had been shrinking in the last years. Just for special reasons, I also have here included the balance sheet of the Swiss central bank. As you know, the Swiss central bank had a policy of a fixed exchange rate between Swiss franc and the euro at 120, meaning that the Swiss central bank was prepared to print Swiss franc to buy euros without any limit. And that, of course, had the effect that their balance sheet was increasing substantially for a certain period of time, the most expansionary, till at some moment, and this moment happened just recently, the Swiss central bank thought that this rapid expansion of their balance sheet proves to be maybe too risky for them, and they stopped this policy. But, and it's no secret, but still intervening on the markets. So the balance sheet still is rising, but it is not rising in such a direct and, let's say, foreseeable way as it had been. It's, by the way, quite interesting as an anecdotal fact that, of course, as the Swiss central bank has this huge amount of currency reserves, because this, of course, all are the euros they buy are their currency reserves. They have quite massive problems how to invest these huge amount of currency reserves, and whereas central banks usually invest in bonds, highly rated bonds, the Swiss central bank has started to invest in equity, in shares. And is one of, so it has become in some way a Swiss investment fund, which is, I think, an interesting and challenging experience. I, as governor of the Austrian Central Bank, I'm quite very happy that I don't have to make these choices, but it is, of course, a new, one of the many new developments that you see in this world. So that, and this shows what I said before, that we have quite different strategies between the Fed, embarking on a much more expansionary policy, and one has to say, together with a more expansionary fiscal policy, which, as we also have seen, has been quite successful, because growth rates have been quite higher, and the ECB, which had been on a much more cautious line. And the announcement made by President Draghi in anticipation of the QE that we are going to have now is in some way that he wants to get back to the amount of the balance of the balance sheet that the ECB had at the beginning of 2012. And this doesn't mean such a big thing here at this graph, but in euros, it's about 1,000 billion, so 1 trillion euros that this increase of the balance sheet is about. So this is what we started at this decision on just 2 weeks ago, and as you see, it's the whole program with this about 1 trillion is including also the existing programs that we have for buying ABS structures, for buying covered bond structures, but of course these are programs that are relatively small. So the real point is buying government bonds and also of agencies and institutions. As I said, the volume will be about 60 billion. It will be only on secondary markets, because otherwise it would be monetary financing, which the ECB is not allowed to do. We have specific qualifications for the bonds that are eligible. One of the important elements, so first between 2 and 30 years, maximum 25% of each issue. One of the important points is that ECB may only buy up to 33% of the total outstanding amount of bonds. And and this is quite important, in this volume are included the volumes that have been bought already by other European institutions in the course of, let's say, some other actions. This means that, for instance, Greece will be excluded from this program because they have already more than 33% of the bonds for a certain period of time, probably also Cyprus. With Ireland it was a discussion, but I think Cyprus will be, or Ireland will be included. The whole, and so it's starting in March 2015, and one of the big issues had been the discussion about risk sharing. And this, of course, has a practical side and, let's say, a theoretical side. The theoretical side, of course, says if you are a true monetary union, there should be no risk. There should be full risk sharing, because this is, if you are a monetary union, so you share the risk via the ECB according to your capital key. On the other hand, of course, there had been the discussion that if we have this, so via the ECB, it may mean a transfer of risk, because of course, if you look at the quality of European government bonds, you have high-rated government bonds, you have very low-rated government bonds. If this all is lumped up together in the volume of the ECB, it means de facto transfer of risk from, let's say, high-risk countries to low-risk countries. And that was, especially in Germany, the discussion that this would, at the end of the day, meaning introducing Eurobonds by the back door. Well, there are, of course, also good arguments for Eurobonds, but I think it would be problematic to do this on the back door. This would need a political decision, which is not available in this way. So that at the end of the day, the decision had been that we have 20% of the asset purchases are in the concept of risk sharing, comprising of 8% of the ECB, because which is the usual percentage of monetary operations for the ECB. So because ECB, of course, is per se risk sharing. And then we have the rest, this 12% European agencies, like the European Investment Bank and so on. The rest will be on a non-risk sharing basis. That means de facto each central bank will primarily buy bonds of their own country. So Germans will buy German bonds, Austrian bonds. In brackets, one could say, if they get it, because that may also be a bit of a problem to achieve. But basically, this is the line. This may look seem to you as a rather complicated way to construct such a thing, and I have to say that in our discussions we discussed for quite a long time the legal foundations for such a project. And as you may know, we have just now ongoing a lawsuit at the European Court of Justice, brought to the ECG via the German Constitutional Court. We have now, there's now an opinion by the Advocate General of the ECG. Basically, this legal issue is about this OMT program, which means this is the famous program that was introduced by Mario Draghi without firing one shot. So we never used €1 for this, but this is this program, so that's saying whatever it means. if a country is really of the Eurozone, is in big troubles, ECB is prepared to buy as long, only under condition, that this country is under a program. So it is not so unconditional, it is with very strict conditions, and therefore it is monetary policy, it's not fiscal policy, but it is a very specific line. And being aware of these very specific legal constraints, this new program was constructed in a way to make sure that we fulfill all those legal consequences and needs that we expect to come from the European Court of Justice. So this will be starting, and if we look at the result of what we have had before, so we see that the programs that we have had up to now have been quite successful. So EONI, so this is the money market rate has gone down. What you see here is with the sovereign bonds. Here, of course, you see this had been the Greek bonds and I think it was also the Portuguese bonds. This was the big crisis of 2012, when there was really the markets speculating on a breakup of the Eurozone. This is what we called redenomination risk. And this is what had been really changed rapidly by a few words of Mario Draghi. We will do whatever necessary. And so you see there has been a rapid rebound. So the markets do not expect today that there will be any danger of a breaking up of the Eurozone. There is a bit of a hiccup with Greece now, of course, but in general, this is the markets have accepted the Eurozone is stable and will not fall apart. Which does not mean, and I think this is important, that bond yields will be the same all over the Eurozone, because this is not the aim of the ECB. The aim of the ECB is to have the same policy rate all over. Of course, then there will be different kind of risk pricing, but what we want to exclude is this what's called the redenomination risk. So you see this has been successful, and it is successful also now. With the new program, you see what I have shown before, that we have had this kind of liquidity provision, and that this is going down, and that now we will have this, and the new program, the QE program, is really to turn this trend again into an increase. This is where I thought we should not had been quoted by the president, also with the Wall Street Journal, that I said before we had this decision, markets should not get too excited about it. Of course, this was a bit of playing down the whole bit hysterical discussion, but in fact, I think one has to be quite realistic. It is, of course, something that may be helpful, where monetary policy is an important condition for an increase, for an improvement in the economic situation, but it is not enough. So it is a necessary but not a sufficient condition, of course. And so therefore one should see it in perspective. What we see, and this is one of the last points that I want to show, with regard to this decision, that we are now in a very interesting situation worldwide, because we have, to an extent that had not been years ago, a rather far-reaching divergence, both in theoretical and practical perspectives. So we have a very strong view from our American friends, or from most of American economists, including the IMF, including the OECD, who urge the ECB to be more aggressive and to be more active. There is another view, some of that coming from a number of German professors, but the one that I take more serious is the one coming from the BIS, the Bank of International Settlements in Basel, where they say, well, expansionary monetary policy had been all right in the crisis, in the after the outbreak of crisis. Now we are getting in the situation where it might lead to new bubbles. And so monetary policy should prepare against these new bubbles. So in this poetic language of central bankers, we call this leaning against the wind. And this has been a big discussion. The majority view, and I share this majority view, is yes, there is, of course, there might be a problem, that this might have a number of side effects, but to counter these side effects, you should not use monetary policy, but you should have to have an additional instrument, and this is what we call macroprudential policy. That means that you have a number of regulatory measures where you can directly influence the bubbles that might erupt. So as to give you an example, for instance, in Switzerland, there had been the danger of a bubble of the real estate prices. So therefore the Swiss central bank, but not the Swiss central bank, but the Swiss monetary authority, so in the capacity of a regulatory agency, issued a number of ways to make loans for real estate, for mortgages, more costly. So by forcing them to have a higher share of own capital, to have higher liquidity and higher capital needs and so on. The ECB, and this is, if you remember this picture with the balance sheets, in that sense has a bit of a middle ground policy. It is not as expansionary as the Fed. It is not as restrictive as advocated by the BIS. So it is some in between. Well, this doesn't necessarily say the middle way is not always the best way, but I think it makes it is a rather cautious, perhaps, way in this point. Last point, and this with this I'll finish. Of course, if you remember what we have said. The first slide, one of the channels is the channel via the exchange rates, and what you see here is, of course, that we have now we are again in a period of quite massive volatility of the exchange rate. So here we had since January this very stable exchange rate of the euro and the Swiss franc, which of course just ended now, and so this is again in a rather dramatic way. Of course, this is even more dramatic if you look at the ruble euro exchange rate. And I would say this is also something that we should be very much aware of. The ECB, as I said before, has as its goal price stability. We do not have an exchange rate goal. So that means volatility in the exchange rates is a side effect of our stability-oriented policy. But of course, it may be a side effect with quite substantial perspectives. For the time being, of course, it is a beneficial part because the devaluation of the euro together with the lower oil prices is perhaps the single most expansionary effect that we have for the eurozone. But I think that at the end of the day, after this time of turbulences, a certain stability of exchange rates is something that would be beneficial for international trade, for long-term planning, and therefore also for economic growth. So what I wanted to give you is an overview of some of the issues that we have to discuss as monetary policy persons. It is only a short view of many other problems, but I think it's enough for a certain discussion, and I look forward to this discussion. Thank you very much.